Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. With everything going on and the market environment changing so rapidly, we're calling this edition From Animal Spirits to Pins and Needles. And at the end of the update, I'll be sharing some really compelling information from an article on managed futures that appeared in Barron's just a couple weeks ago. But for now, let's get to the commentary for the month that was March 2025. Over to you, Andrew.
Thank you, Mike. So I'm writing this a day after Trump announced a sledgehammer of global tariffs, and the markets are not happy at all. But today I'm going to concentrate on what happened in March and the first quarter. Now, as a heads up, on April 24th, Mike is hosting another Zoominar, where we will review both the strategy and, of course, provide an update. So please carve out time to join if you can. Also, as always, please do not hesitate to reach out if you want to speak live or even if just to compare war stories. Now, on the portfolio side, CTAs continue to get hurt by the unwind of the Trump trade. As discussed previously, long equities, short bonds, long the dollar, and long gold. In March, DBMF modestly underperformed the SocGen CTA index, here and after the hedge fund index, and the Morningstar US systematic trend category, here and after the Morningstar category, and we're slightly behind both year to date. Anyway, it's getting wild out there. Now, Trump keeps shattering norms, and the entire world and markets are trying to figure out how on earth this will all play out. Now, it's not just the Trump disruption machine, but also the second and third order effects, such as the wild spike in the euro last month when Germany and other nations decided to ramp up defense spending and, quite possibly, break out of decades of economic malaise. So the animal spirits of last fall is being replaced by this sense of pins and needles. Now, as I keep saying, strap in, peoples. This is going to be both a volatile time, but also a good time to remain liquid and diversify. Next slide, please. This slide shows year-to-date performance of DBMF versus the SGCTA, Morningstar category, and Bloomberg US Ag. Now, March was wild on the macro front. Our portfolio had a meaningfully larger peak to trough drawdown relative to the hedge fund index, a reflection of our concentration in the euro, but had largely recovered by month end. Now, there's a long-standing debate among allocators as to whether investing more and more futures contracts improves diversification and risk-adjusted returns. That tends to be more relevant for actual CTAs than replication. Now, one counterargument is that in a true market meltdown, liquidity tends to evaporate in those secondary or tertiary positions and can exacerbate losses. Given the macro backdrop, we might have a good opportunity to test this thesis over the coming months. Next slide, please. Now, turning to inception to date performance, DBMF has, of course, outperformed the hedge fund index and by a wider margin the Morningstar category since launch in 2019. Now our drumbeat is that replication is a systematic, repeatable investment process with structural alpha, with alpha based on efficiency and lower fees. Alpha is scarce, and we want our clients to get more of it. As noted, please feel free to contact Mike, and he can share both a longer track record of our live performance and for capital markets assumptions and benchmarking. The index SocGen built using our replication engine, which goes back to 2002. Next slide, please. So here's our slide on volatility adjusted positioning. The red dots are from the end of December and the green bars are from the end of March. As you can see, the portfolio has been in flux, not at all surprising given the market volatility. During the quarter, the big moves from left to right were to increase long exposure to gold, cut back on a large short euro position, which helped last fall but has hurt performance this year, cut back on bets on rising long-term rates as in recession fears mount, and a shift to favor non-US stocks over US stocks, perhaps an early sign of a reversion to the mean evaluations or an end of the American exceptionalism trade. Which brings us to the next slide. Now here's contribution by factor. Those two bars say it all. We made money on the long gold position, but we're definitely on the wrong side of the spike in the euro. The rest of the portfolio was comparatively uneventful. Now, a quick word about these markets. Price moves are extreme these days. It is impossible to tell in the moment if they're driven by shifts in fundamentals or frantic unwinds in crowded trades. Moreover, Small variations in positioning, e.g., our overweight euro relative to the hedge fund index, can lead to wider than expected differences in P&L over short periods of time. So given this, my expectation is that we'll see a wide dispersion among CTA hedge funds and mutual funds over the coming months, which may reinforce the argument that we've made about replication, that it's an effective way to reduce single manager risk. Now, with that, I'll pass the baton back to Mike.
Thanks, Andrew. So, as I mentioned, there was a really interesting article that appeared in the March 22nd edition of Barron's titled, "Managed Futures Are Hot, You Can Manage Without Them." While that title wasn't so favorable, the data within and the copy around it was actually quite positive for managed futures as an asset class, but it was also incredibly supportive of DBMF and our low fee replication approach. So let me explain that here. Starting by quoting the article itself, quote, "There's an index of popular managed futures strategies from SocGen that goes back to 2000. Morningstar found that it had returned 4.8% a year versus 5.9% for global stocks and 3.9% for global bonds. That's impressive, even if global stocks haven't done nearly as well as US stocks in recent decades, and if high managed futures fees can erase the edge over bonds," unquote. Now, our clients know the core approach behind DBMF, that it seeks to deliver the pre-fee returns of that SocGen index, which is fully loaded with the underlying cost of its components. And since inception, DBMF has delivered almost 200 basis points of outperformance against that index. By extracting most of those fees, DBMF has sought to deliver much more of the value of what the managed futures asset class can provide for investors, and that three-punch combination that alternatives should actually provide: absolute return, alpha generation, and no correlation to traditional asset classes. If you choose to extrapolate or back calculate pre-fee managed futures performance when building models alongside capital market assumptions, knowing that past performance is not a guarantee of future returns, we believe that you'll find DBMF remains one of the most compelling value-add alternative investments allocators can add to a traditional portfolio. Okay, so wrapping up with long-term performance numbers, DBMF's annualized return since inception, including the month that was 2025 of March, is now 6.53%, ahead of the SocGen CTA index by 194 basis points annualized, and ahead of the Morningstar systematic trend average by 349 basis points. The AG came back further in March, but long-term performance against it by DBMF remains well intact. DBMF outperforming by over 540 basis points annualized. So thanks as always to our clients and to our prospective clients for your confidence and your interest in DBMF. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgbfunds.com.